Hello everyone and Assalamu alaikum. Today I want to show you one of my data science and financial analytics project called Financial Simulator. This project uses Monte Carlo simulation, probability statistics and risk analysis to estimate how a stock price might have behaved in the future. So before moving towards its details, I will give you its background. In financial market, nobody knows the future. If a stock is currently loading or trading at 100, we cannot say with certainty that it will become 120 or 80 next year. There are countless possibilities. Traditional forecasting often gives a single estimate, but real markets are uncertain. This uncertainty creates risk, so instead of asking what will happen, we ask as a trader or as an investor what could happen. This is where Monte Carlo simulation becomes extremely useful. Now I'm moving towards Monte Carlo simulation. Basically, it is a statistical technique that uses random sampling to model uncertainty. Rather than calculating only one future outcome, it generates thousands of possible future paths. Each simulation represents a different version of reality. Some paths produce gains, some produce losses, and some stay near the average. So it's about all its background. Now I am going towards the project overview. On the left side, guys, if you see that we have the simulation parameters. These are my simulation parameters. On the right side, we have visualization and risk matrices generated from simulation. The user can adjust the inputs and instantly see how risk and expected returns to change. Starting price. The first parameter is in parameter section A, starting price. In this example, the stock starts at rupees 100. This serves as the initial value for every simulation. All future stock price paths begin from this point. The next parameter is expected return. Here the expected annual return is set to 12%. If we convert 0.12 to it, so it converted to 12%, this value represents the average growth rate we expect from the stock over the time. The next parameter is volatility. Volatility basically measures how much the stock price fluctuates. This is one of the most important variables in finance because it represents less. Basically, a low volatility stock tends to move slowly and a high volatility stock experiences larger price swings and vice versa. The next parameter is trading days. The simulation runs for 252 trading days. Basically, an year in finance, 252 trading days roughly represent 1 year or full trading year. The next is parameter is number of simulations. The simulator runs 1000 simulations. This means the model generates 10,000 different possible futures for the stock. The larger the number of simulations, the more reliable the probability estimate become. Now I move towards the risk matrix section. The risk Next, we move to the risk matrix section. This matrix summarizes the whole simulation results. The expected price represents the theoretical value predicted by the model. So the first parameter is the mean. What is mean? The mean is the final price is approximately 112.67. This represent the mean represent all the average ending stock price across all 1000 simulations. Basically, the mean is the average of all the data in a given data set. If we average every simulated outcome, this would be the result. The next parameter is median. The median final price is approximately 110.34 according to the risk matrix. Basically, the median represents the middle value in a given data set. Although it has two types, for a given and for a odd, half of the simulation ended above this value, half ended below it. Many analysts consider the median a better representation of a typical outcome because it is less affected by extreme values. The next and the most important parameter in statistics is standard deviation. The standard deviation measures variability. It tells us how widely the results are spread along the mean. A larger standard deviation indicates greater uncertainty at higher risk. In finance, risk and uncertainty are often measured using standard deviation. At the last, there are two furthermore parameters, minimum and maximum. The minimum simulated final price is approximately 49, 48, round about 49, and the maximum simulated final price is 233. This represents an exceptionally strong upside scenario. Together, these values show the full range of all possible outcomes. Now I will move towards the right side, which shows the graphs. Graph 1, top graph. Now the graph is generated, the first one graph, which is generated using Monte Carlo simulation. On the horizontal axis, guys, on the horizontal, these line guys, on the horizontal axis we have trading days. You can see 50, 100, 120, 200, 250 and up to so on, representing approximately 1 year of market activity. On the vertical axis we have stock price. You can clearly see that 80, 100, 140, 160 and 180 and up to so on. Each color line represent a different possible scenario for the stock. Each color line, guys, blue, red, yellow, each color line represent a different possible stock. Notice that every line starts from the same point, which is the initial stock price, which we provided is 100 rupees. As time progresses, or sorry, $100 or 100 rupees, as time progresses, random market fluctuate causes each path to move differently. You can clearly see from these lines that each path has a different scope. Some path moves significantly upward, representing strong market performance. Some path moves downward, representing potential losses. Other represent relatively stable. There is not a single future outcome. Instead, there are thousands of possible different futures. The middle line, the sign line, the green line represent the mean path. This line is calculated by averaging all the simulated stock prices at every point in time, which I clearly described before while explaining median. Looking at this graph, we can immediately see both opportunity and uncertainty. While the average path trends upwards, individual simulations can vary significantly. Now let's move towards the graph 2, which is a histogram. Now this graph summarizes the results of basically 10,000 simulations. It is a basically summarizer graph. Instead of showing how prices moved over time, it focuses on the final stock prices at the end of the simulation period. Guys, on the horizontal axis we have the final stock price, and on the vertical axis we have the frequency, which indicates how many simulations ended with a particular price range. Each blue bar represent the number of simulated outcomes that fell into the specific price interval. The tallest bar indicate the most probable outcome. As we move away from the center, the bars become smaller because extreme outcomes occur less frequently. This creates a probability distribution that helps us to understand where the stock price is most likely to finish. And at the center, guys, you can clearly see the green vertical line represent the mean final price. What is mean? Mean is the average value in a given data set, which is average outcome across all simulations. And the yellow line, vertical line, represent the median price. Median is the middle value in a given data set, which divides the distribution into two or three halves. I think into two equal halves. And at the last, the red line represent the starting price, which is 100, allowing us to compare the simulated outcomes against the original investment. If you guys notice that mean and median are both above the starting price, indicating investors who can invest in this scenario a positive expected return. If I move towards its code section a little bit, I used random module normal distribution concept in this aid. Basically, the in a real life a stock market, the data is real because it comes from real market. So in my case, I used to generate data, so it is not a real data just like market data. So I used to generate 1,000 data or 1,000 number of combinations because of random module normal distribution. The normal distribution generates thousands of different data. This simulation uses NumPy random normal distribution to generate random market movement. These random values represent uncertainty and allow us to create thousands of different possible future stock price scenario, as I will clearly explain it. I then used mean. I clearly say that mean is the middle value in a given data set. Oh, sorry, median. Mean is the average standard deviation. Standard deviation shows us that how our data are spread from its original value as an indicator for investment risk and uncertainty. Minimum value and maximum value percentiles. Percentiles basically, I if you look at this bars, there are also shows percentiles. What are percentiles? Percentiles, deciles, and quartiles. There are basically three types. Percentiles are used to estimate value at risk, allowing us to quantify potential losses to the investors under adverse market affection. So at the last guide, this project basically uses NumPy random module for generating normally distributed market stocks, array operations for vectorized calculations, and universal functions such as exponential, squares, or cumulative frequencies comprod for stock price modeling. Thank you so much.